Here is the CIO house view this month in short. Persistent inflation, high rates, some falling growth estimates, recession a little less elevated, and some heightened financial stress. They do make the short term for markets a bit challenging. But what about the long term? And what does this mean for your investing future? We're going to break it all down for you right now on UBS Trending. Hi, everybody, and thank you so much for joining us. I'm Anthony Pastore. Welcome to UBS Trending. Leslie Falconio and Jason Draho are back in the studio with me today to break down the latest house view. Thank you both for being here. Jason, I want to start with you. Talk us through the house view update this month, and specifically how some of the economic conditions that we have seen of late over the last month or so have informed where you're headed here with the house view and the messages that are in there.
So we titled the house view update and also our second half outlook balancing act. And so I think it kind of reflects the fact that, some of the comments you alluded to what the economic environment has been like so far this year. Where we're seeing some of the latest data suggests, the risk of recession coming down at least a little bit, at least the timing is probably being pushed out later to the year. So a little more optimism on the macro environment. If we think back to the start of the year, there's a lot of pessimism that we would get a recession by the middle of the year. That hasn't materialized. People were very skeptical that would be a soft landing. Now that seems, definitely possible, not definitive by any stretch of the imagination, but it's a little more. The macro outlook looks like, let's say, a little bit more balanced. So that's kind of a positive for the macro. The issue for the markets is that a lot of that good news is already sort of fully priced in after a pretty strong start to the year, and even over the past month or so, equity markets have rallied quite a bit. So good news on the macro, but even probably more good news is being priced in the markets. So the view that we've had is to be a little bit cautious on equities overall. We're kind of least preferred on equities, preferring bonds. That message didn't change kind of overall. So the outlook looks better at the macro outlooks, but a lot of it's kind of reflected in the market pricing overall. And that's the key kind of point. To go forward, it really depends on things kind of playing out well, like those economic improvements kind of continuing on, the Fed not getting overly hawkish, and sort of AI been a strong market driver, that not suddenly kind of reversing and being kind of a headwind for the markets.
Terrific. Jason, thank you. Yeah, there's a lot to digest there. Obviously, we're looking at a surge in equity markets, but really led by those top 7 names in the S&P, which we're calling the surging 7, big tech, et cetera. And Leslie, we can't ignore the actions or potential actions from central banks. I mean, we know that Christine Lagarde and from the president of the ECB raised rates by 50 basis points, indicating there may be more to come. Jay Powell from the Fed here in the U.S. has indicated that there may be rates coming in the future. How does that change the way you can view where we should be investing money, particularly when it comes into fixed income?
No, I mean, I think that the most important thing about the Fed meeting was the adjustment in terms of their economic projections, where they sort of guided the market that they probably have, another 50 basis points to go. Now, as the market normally does, they're ignoring the 50 basis points right now, and they're only putting in another 25 basis point rate hike, right? So I think the important part of how the market has shifted, which is really has been a large shift, has been they're finally believing in the higher for longer strategy. Right? The 100 basis points of easing that was priced in May for the second half of 2023 has been removed. And I think that now, even with the higher for longer, over a period of time, that could be restrictive, right? We know that borrowing costs and, to both corporations and consumers will remain higher. As we go through sort of this excess savings from the consumer, the headwinds of higher interest rates might be felt in a more strong impact. But I do think that, more than likely the Fed will go again, as Jason mentioned, depending on some of the data. But the market is not quite at the 50, it's only at 25.
Yeah, I should have led with the fact that we were, just to recall that the Fed did not raise rates in June, as was expected. But we'll have to see what goes forward. And we're going to get more into your recommendations on the fixed income side in a moment, Leslie, because there's a lot to talk about there since fixed income is most preferred in the house view. But Jason, back to equities for a second. I was sort of leading the witness there for a moment, talking about this performance that we've seen in S&P. It's up 14%, but you've got some big names at the top of the leaderboard that have really carried that entire index. But still, we've got global equities at least preferred. Tell us a little bit more about what's going on the equity side.
So as you mentioned, equities, the S&P 500 up 14% this year, but there's almost 2 different markets. There's 7 mega cap stocks that have done fantastically well, up 30% plus, 100% plus in some cases, and there's everything else, the other 140, 493 stocks. So one, we have to kind of think about those two distinctions. But what it does mean is that the market's done quite well. We think overall at the sort of index level, it's priced for a lot of good news, as I mentioned before. So for markets to go a lot higher, you need to see growth being resilient, the labor market holding up. You need to see inflation coming down. And in fact, I think what the data points I would look most critically at the next couple of months are like, do you see inflation falling? And we're going to see inflation coming down. It's already come down a lot, but like from a year-over-year effect, big declines in headline CPI. Maybe as low as 3% for June and close to 2.5% for July that we're going to get in early August. Suddenly it's going to look like maybe inflation is kind of solved from that perspective. That could be a tailwind for equity markets. If it isn't, then there's a chance for equities to kind of pull back. So what we like then with an equities is not so much chasing the markets overall, but thinking, well, there's a big chunk of the market that's lagged. And so one of our key messages and focus this month, a new one, is to look for those equity laggards. Look for the opportunities in the markets that have lagged. Think about your portfolio, if it has those growth stocks, it has those tech stocks, to rebalance, especially as we come to the mid-year point. It's a good time to kind of think about rebalancing your portfolio.
Right.
The laggards include things like value stocks. Just an equal weighted index of the S&P 500 has underperformed by about 10 percentage points. That's highly unusual in a short period of time. That's something a simple way to kind of get that exposure. We also like energy stocks. We upgraded that. Again, the worst underperforming sector this year, down 10%. If things are okay globally, that's an area that has attractive valuations, can do well in sort of a catch-up trade.
Terrific. And given that there are some opportunities there in equities, but generally speaking, least preferred from a global perspective.
Correct.
But there are pockets there. Thank you, Jason. Leslie, on the fixed income side now, obviously we can't ignore where rates have gone. We can't ignore what central banks are doing, but that's not the full story. There's lots of parts within the asset class that you see opportunity there too. And since we have most preferred on fixed income now, tell us where you're recommending investors put their money on the fixed income side.
It's interesting because if you look where we started the year, let's say in 10-year treasury yields to where we are right now, it's about 10 basis points lower. IG corporates are 2 basis points tighter. So with all this intraday volatility, you've really done a lot of nothing, right?
It's almost a flat line if you look at it,
but
right?
the benefit to this, in terms of we also like the higher quality too, is that the positive total returns that we're generating have been through yield and through carry. And these yields are obviously, well above their 10-year average. And going forward, we're not expecting this huge amount of price appreciation because we think treasury yields, collapse. But we do appreciate that carry. We definitely appreciate the carry that's offered in the higher quality type sectors. Now, there is a sector that we have been most preferred that has done well and it's tightened in, are preferreds, right? Because of that pocket of vulnerability they saw in the beginning of March and about a month thereafter, what was happening with regional banks, you saw a widening in spreads there. Now that's come in year to date, and they're about 60, 70 basis points tighter in spreads, and you can get the carry from that as well. So we're still going into the higher quality type sectors because we are at the later stages of the credit cycle. We don't know exactly when the Fed's going to be done definitively,
right,
but we're assuming that terminal rate is not very far away from where we are today. So that's why we like the higher quality. Also, as well, as when we think about where we want to be positioned, because of the removal of the Fed easing in the second half of the year, because Powell was fairly hawkish, the yield curve has sort of inverted in a more deep manner, meaning that we're about a negative 102 between 2's 10s. That's a very inverted yield curve. Because of that inversion, we like to play the barbells. We want to take that capital, that yield in the short end, we want to lock in a little bit in that 7 to 10 year, and we average around that 5-year area of the yield curve. And that 5-year has a tendency to lead the way when monetary policy shifts, right? So if they're hawkish, the yields go higher first. When they're dovish, they come down first. And because we are at the end of the cycle, even if we stay higher for longer, which we will, the market will start to price in that easing in 2024.
Right, but that's really the key, though. It is higher for longer, as that's what the expectation is. That's what investors should be considering.
Finally, the market shifted to higher for longer. They've been pounding the table on that for a very long time, and the market didn't believe them until they saw the data that we've recently seen, which is what Jason was mentioning, pushing out that recession a little bit further.
Terrific. Thank you both for being here. Jason and Leslie, always good to have you here. And that was the House View at a glance. That's for July. So take a look at that House View report. You can find it in various locations, including our Insights website at ubs.com/views. And make sure to follow us on social media. We're on all of the major social media channels, including Instagram, where you can find our brand new @UBS Trending channel. for all the studio's content that you cannot find anywhere else. So check that out when you can. And as always, if you have any questions about what we spoke about today, talk to your financial advisor. Until next time, I'm Anthony Pastore. Have a great rest of your day, everybody, and remember to keep your eyes on what's trending. We'll see you soon.